Welcome back to Earth Economics. In this chapter, we are going to discuss the three central concepts in macroeconomics, that is output, unemployment, and the inflation rate. First, we'll be talking about the concept of output in terms of GDP, that is real and nominal, then unemployment rate, inflation rate, and a key relation between these three factors, that is output, unemployment, and inflation rate. Finally, we'll be concluding with the three central concepts in economics, that is the notion of short run, medium run, and the long run. If you like the content of our videos and want us to contribute more, you can support us by subscribing to our channel and following us on the social media platforms. Let's begin. The aggregate output. Economists studying economic activity in 19th century or even during the Great Depression, which we have discussed in our previous chapter, had no measure of economic activity on which they could rely, and they had to put together the bits and pieces of information such as the shipment of iron ore or sales at some departmental stores and try to infer what was happening to the economy as a whole. But there was not a broad measure with which they can gauge that how the economy was performing over time. Now, it was not until the end of Second World War that national income and products accounts were put together. Now, measure of aggregate output have been published on regular basis in United States since then, that is 1947. Two economists made a notable contribution to national income accounting, that is Simon Kuznets from Harvard University and Richard Stone from Cambridge University, who received the Nobel Prize for their contribution to development of national income and products accounts. Okay, and this has been a really challenging intellectual and empirical achievement. Now, like any accounting system, the national income account first define concepts and then construct the measures corresponding to these concepts. Okay, and one by one we are going to look into these, and broadly speaking, what we are going to discuss about is how to go about estimating the output of an economy, which we know is commonly goes through the gross domestic product or the GDP. Okay, so let us now discuss about what is GDP. To define, GDP is the aggregate measure of output in national income accounts. To understand how this is constructed, it's best to work out with an example. Now, consider an economy composed of just two firms. The firm 1 is producing wood for the furniture making company. Company 2 is the one which is making furniture. Now, the firm 1 which is producing wood is employing workers and using some machines to produce the logs of wood which it's going to supply to the furniture company. It sells the wood for, let's say, $100 to firm 2, which produces furniture. Now, furniture, let's assume the furniture is table. Okay, so the firm 1, it's paying its workers, say, $80, leaving $20 profit for the firm. Firm 2, it buys these logs of wood and uses its workers and machines like firm 1 and produces a table. Now, revenues from the sale of these tables is, say, for example, $200. Now, of the $200, the $100 goes to pay for the furniture to firm 1, okay, for the wood which it's coming from firm 1, and $70 goes to the workers in the firm 2 who were working, okay, and leaving behind the $30 profit to firm 2. Now, in the process, how could you define aggregate output in this economy? So, as the sum of all the values of goods and services produced in the economy, the sum of $100 from production of the wood logs and $200 from the production of table, so it's going to be $300, or just the values of the tables which is equal to $200. Some thought suggests that right answer must be $200, and the reason to this is because because furniture making wood is an intermediate good. The wood logs which were being supplied by the firm 1 are intermediate good. That is, it is used in the production of the tables. Once we count the production of the tables, we do not want also to count the production of the goods that went into production of these tables. Now this leads to the first definition of GDP. That is, GDP is the value of final goods and services produced in the economy during a given period. Here final is the key word. Okay. Now the important word is final, like I mentioned. So we want to count only the production of final goods, not intermediate goods. Now using our example, we can make this point in another way. Say the two firms have merged now. The same firm is getting the wood from the forest and it's the same firm which is producing those tables as well. So what happens now? The sale of the wood which took place in the new firm, okay, it's no longer recorded because the same company is doing those things. Now the accounts of the new firm would be given as the revenue from the sale is going to be $200, the expenses are going to be $150, and the profit will be $50, right? So all we would see would be one firm selling the table for $200 and paying the workers $150, right? $80 to those who were chopping woods and making those logs, and another 70 those who were working out to make a table, right? And this makes it up to $150, and making profits, if we talk about the profit side, so that would be around 50 only, right? That is $50. The $200 measure would remain unchanged as it should. So we do not want our measure of aggregate output to depend on whether firms decide to merge or not. So this first definition gives us a way to construct GDP by recording and adding up the production of all final goods. And this is indeed roughly the actual GDP numbers, the way they are put up together. But it also suggests a second way of thinking about GDP. GDP can also be defined as the sum of the value added in an economy during a given period. The value added by firms. So this approach is, the second approach is also known as the value added approach. The value added by a firm is defined as the value of its production minus the value of intermediate goods used in the production. Okay, like the example we have discussed in our two firm example, the company which does not use intermediate goods. The examples which we have discussed so far, the woodlog company does not require the use of intermediate goods. Its value added is simply equal to the value of the woodlog it's producing, that is $100. The table manufacturing company, however, uses woodlogs as an intermediate good. So the value added by the furniture company is equal to the value of the tables it produces minus the value of wood which acts as an intermediary in this production of tables. So $200 minus $100, which gives $100. So total value added in economy or GDP equals $100 from stage 1 when wood logs were being produced to that of $100 additionally which are coming up from the table manufacturing unit. So it equals to 200 USD. Now in this case, we would not observe intermediate goods at all because wood logs would be produced and then used to produce tables within the single firm. And the value added in the single firm would simply be equal to value of tables, that is $200. In the discussion so far, we have looked at GDP from the production side. The other way of looking at GDP is from the income side. If we go back to our example and think about the revenues left to a firm after it has paid for its intermediate goods, some of the revenues go to pay workers. This component is called labor income. The rest goes to firm. That component is called capital income or profit income. And the reason it's called capital income is that one can think of it as a remuneration for the owners of capital used in production. Okay. And of the $100 of value added by the woodlog manufacturing company, $80 were going to the workers, that was labor income, and the remaining $20 were coming as capital income to the
woodlog company. Of the $100 value of $100 value which was being added by the table manufacturing company, furniture company, $70 were going to labor as income and $30 were coming as profit income to that company. For the economy as whole, labor income is equal to $150, that is 80 in the first and 70 in the later case, and capital income is equal to $50, that is 20 for the woodlog company and $30 for the table manufacturing or furniture company. Now value added is equal to sum of labor income and capital income, that is $200, 150 plus $50 for the former and the later company. This leads us to the third definition of GDP, that is GDP is the sum of incomes in the economy during a given period. So to summarize, we can think about aggregate output or GDP in three different but equivalent ways: nominal and the real GDP. Let us assume that in a country, the GDP of the country increased in 5 years from 3,000 billion to 15,000 billion dollars. But does that mean output increased by almost 5 times? Obviously not. Much of this increase reflected an increase in the prices rather than an increase in the quantities produced. This leads to the distinction between nominal and real GDP. Let us try to understand what it means. To define, nominal GDP is the sum of quantities of final goods produced times the current price. This definition makes clear that nominal GDP increases over time for two reasons. Number one, the production of most goods increases over time, and number two, the price of most goods also increase over time, right? So if our goal is to measure production and its change over time, we need to eliminate the effect of increasing the quantities. Now, how to go about that? If the economy produced only one final goods, let us say a single car model, constructing real GDP would be easy. We would use the price of the car in a given year and multiply the quantity of cars produced in each year. An example here is to illustrate is as follows. Consider an economy that only produces cars, and to avoid issues we shall tackle later, assume that the same model is produced every year. So there is uniform homogeneous production going on. Suppose a number and the price of cars in the 3 successive years is given as follows in the table, that is for 2013, 2014 and 2015. Okay. Now nominal GDP, which is equal to the quantity of cars times the price, goes up from 200,000 pound in 2013 to 288,000 pounds in 2014, a 44% increase, and from 288,000 pounds in 2014 to 338,000 pounds in 2015, a 17% increase. To construct real GDP, we need to multiply the number of cars in each year by a common price. Suppose we have the price of the car in 2014 as the common price. So this approach gives us the real GDP in 2014 euro terms, right? So using this approach, real GDP in 2014 euro terms will be equal to 10 cars times 24,000 euros per car. Okay, when it's multiplied, so we get that 240,000 figure for 2013. Likewise for 2014 and for 2015 we have 288,000 and 312,000 respectively. So the real GDP goes up from 240,000 euro in 2013 to 288,000 euro in 2014, a 20% increase, and from 288,000 in 2014 to 312,000 in 2015, an 8% increase only. So how different would our results have been if we had decided to construct real GDP using the price of a car in say 2015 rather than 2014? Okay, obviously the level of real GDP in each year would be different because the prices are not same in both the years, that is 2015 and 2014, but its rate of change from year to year would be the same as shown. right? The problem when constructing real GDP in practice is that there is obviously more than one final good. Like we have assumed there is only one final good being produced, that is cars. But in an economy, you have n number of goods being produced. Okay, so real GDP must be defined as the weighted average of output of all final goods. Okay, and this brings us to what the weights should be. Now, when we talk about the weights, the relative price of goods would appear to be natural weights. If one good costs twice as much per unit as another, then that should count for twice as much as the other in construction of the real output. But this raises the question, what if, as is typically the case, relative prices change over time? So we know that relative prices tend to vary over time for different goods, right? So should we choose the relative prices of a particular year as weight, or should we change the weights over time? More discussion of these issues and the way real GDP is constructed across the economies can be explored from the National Income Account Statistics website of each country. So every country has a specific method which they use to arrive at the GDP numbers which they present or report. It is beyond the scope of our current discussion, but one should remember that the term nominal and real GDP each have many synonyms, and you are likely to encounter them in your readings. Nominal GDP is also called GDP in current prices or GDP in current euros or current dollars. Okay, so key thing here is GDP in current prices is the nominal GDP. Whereas for real GDP, you may be encountering terms like GDP in terms of goods, GDP in terms of constant euros or constant dollars, GDP adjusted for inflation or prices, or GDP in chained form of currency. Okay, so these are all synonyms for real GDP, but most commonly you will encounter GDP in constant prices. Okay, so in the chapters that are going to follow up, unless we indicate otherwise, GDP will refer to real GDP. Okay, and it will be denoted as YT, where T denotes the year in which that real GDP is being reported. For the nominal GDP and variables measured in current prices, they will be denoted by a currency specific sign, for example euro sign in front of them or dollar sign in front of them. For example, dollar YT or pound YT, okay, for nominal GDP in that year for a particular country. This figure simply shows the growth in GDP in the European Union and the United States since 1971. As you can see, the growth rate is given as current year minus previous year upon previous year output. The second key macroeconomic variable which we had talked about was unemployment rate. Now let us see what it means and why does unemployment numbers matter for the economists. The first reason is because of its direct effect on the welfare of the unemployed. Although unemployment benefits are more generous today than they were during the period of Great Depression, unemployment is still associated with financial and psychological suffering. The extent of suffering depends on the nature of unemployment. One image of unemployment is that of stagnant pool of people remaining unemployed for long periods of time. In normal times, in United States for example, this image is not right. Every month many people become unemployed and many of the unemployed find jobs as well. When unemployment is high, however, as it was during the crisis, another image becomes more relevant. Not only are more people unemployed, but also many of them are unemployed for a long time. For example, the mean duration of unemployment was 16 weeks on an average during 2000 to 2007, but it increased to 40 weeks in 2011 for the US economy. When unemployment rate increases, not only does unemployment become more widespread, it also becomes more painful for those who are unemployed. The second key reason why economists care about the unemployment rate is because it provides a signal that the economy is not using some of its resources. Most importantly, the human resource is not being used. When unemployment rate is high, many workers who want to work do not find jobs. The economy is clearly not using its human resources efficiently. What about when unemployment is low? Can very low unemployment imply the same problem? The answer is yes. Okay, a low unemployment rate, like an engine running at too high speed, an economy in which unemployment rate is very low will be overusing its resources and may run into labor shortages. How low is too low? Like, what should be the optimal band within which the unemployment figures should be? This is the difficult question, and the question that as of early 2020 2021 is very relevant. As shown in the figure, the unemployment rate in the 15 European countries and the United States since 1981 had been reported below 6% level up till 2019. But we all know that ever since the COVID-19 pandemic came, all these figures shot up, and those numbers were even reported in the double-digit figures for different economies. Let us now try to define what unemployment rate is. First of all, employment is the number of people who have a job. Unemployment is the number of people who do not have a job but are looking actively for one. The labor force is the sum of employment and unemployment. So L is given as the sum of N, that is employed plus the unemployed, U, or labor force equals employment plus unemployment. The unemployment rate is defined as a ratio of the number of people who are unemployed to that of the labor force. Okay, so unemployment rate is the ratio of unemployment upon the labor force. It should be noted that to be classified as unemployed, a person must meet two conditions. He or she does not have a job, and he or she is looking for one. This second condition is harder to assess.
The next theme of discussion is the inflation. Now, inflation is sustained rise in price levels, the rate at which the price level increases, and symmetrically, if you have to think of inflation, the term used is deflation, which means the sustained decline in the price level and corresponds to a negative inflation rate. The practical issue in terms of measuring inflation is that how to define the price level of inflation. Okay, and macroeconomists typically look at these measures of price level in terms of the indices, and key among them which we are going to discuss in the subsequent section are the GDP deflator and the consumer price index. You would have noticed that inflation related debate dominates even the political discourse, but we need to answer first that why do economists care about inflation? Now think of a scenario if a higher inflation rate meant just a faster but proportional increase in all the prices and wages. So the rate at which the prices of the commodities were increasing for a consumer, likewise the wages were also increasing. So in that case, inflation would not be any inconvenience or a very minor inconvenience because relative prices would be unaffected. But during periods of inflation, not all prices would rise proportionately, because they don't. So inflation affects income distribution. For example, if retirees in some countries receive payments in the form of pension that does not keep up with the price level, so they lose in relation to other groups when inflation is high. Another key aspect related to this is that inflation leads to uncertainty, making it harder for firms to make decisions about the future, such as investment decisions. Some prices which are fixed by law or regulation, they tend to lag behind others, leading changes in the relative prices. Further, taxation interacts with inflation to create more distortions. Now, how does that happen? If tax brackets are not adjusted for inflation, for example, people move into higher and higher tax brackets as their nominal income increases, even if their real income remains the same. So it can lead to such distortions as well. Now, the measures of inflation. The first key measure is the GDP deflator. It is defined as the ratio of nominal GDP to that of real GDP in a given year. It should be noted that this deflator is also an index number and has no economic interpretation because the base year is chosen arbitrarily for this as well. But its rate of change has a clear economic interpretation. That is, the rate at which the general level of prices increase over time, the rate of inflation. Nominal GDP is equal to the GDP deflator times real GDP, or in terms of rate of changes, the rate of growth of nominal GDP is equal to the rate of inflation plus the rate of growth of real GDP. The next measure which we are going to discuss is the consumer price index, and this is the measure which is widely used across the central banks to gauge inflation. Now, the GDP deflator gives average price of output, that is the final goods produced in the economy. But consumers care about the average price of consumption, that is the goods they consume. The set of goods produced in economy is not the same as the set of goods which are purchased by the consumers, because we know that demand and supply are never going to be in equilibrium. Some of the goods in GDP are sold not to the consumers but to the firms in the form of machine, equipments, etc. that we call as capital goods, also acting as the intermediaries, or to the government or to the foreigners. Some of the goods bought by the consumers are not produced domestically, they are imported from abroad. Now, to measure the average price of consumption or equivalently the cost of living, macroeconomists look at another index, that is the CPI, Consumer Price Index. It should be noted that in the subsequent chapters also, we shall be simply talking about the price level and denoted by PI or PT without indicating whether we have the CPI or the GDP deflator in mind. Newspapers sometimes confuse deflation and recession. They may happen at the same time, but they are not the same. Deflation is a decrease in the price level, and a recession is a decrease in real output. So far, we have discussed about the measure of output in terms of GDP, then the measure of price levels in terms of the GDP deflator and inflation. Now, this theme is about output, unemployment, and the inflation rate, which is basically explained in terms of linkage by what we call as OKUN'S law, though it is an empirical regularity but not a law. What it suggests is that if output growth is high, unemployment will decrease, and this is indeed true. How? Because in general we know that when the prospects of growth in an economy are going to go up, we can expect more business activity to take place, and in the process there will be employment opportunities being created and unemployment numbers going down. So specifically defining, OKUN'S law implies that with strong enough growth one can decrease the unemployment rate to very low levels, and this figure is summarizing the case for European Union's 15 countries between the period 2000 to 2019, and you can see that the unemployment rate has been declining with the increase in the growth rate. Another key concept which relates output, unemployment, and inflation is the Phillips curve. Now, OKUN'S law was stating that with the strong growth one can decrease the unemployment rate, but this intuition suggests that when unemployment rate is low, economy is likely to get overheated and there will be an upward pressure on inflation. Why does this happen? Is simply because when the business activity, like in previous case of OKUN'S law, was booming because of the strong growth, we stated that employment opportunities will be high. But as a consequence, when employment opportunities are going to increase, people will have more money in their pockets to buy commodities. And when the purchasing power increases, obviously the demand for goods will increase, and hence there will be a rise in the prices of the commodities. and hence the outcome is the inflation rate goes up. This relation was first explored in 1958 by a New Zealand economist, A.W. Phillips, and has become to known as the Phillips curve. The figure below is summarizing the same statement for the euro area between the period 2000 to 2019. Three key issues or concepts which will be recurrent across the discipline of macroeconomics or themes related to macroeconomics would be the notion of short run, the medium run, and the long run. And even in the policy debates, this remains as an issue of discussion. To answer this, let us try to begin with the question asking what determines the level of aggregate output in an economy. Now consider three answers. Movement in output comes from movement in demand for goods. Then what matters when it comes to aggregate output is the supply side, that is how much an economy can produce, which again makes sense. Then finally, a country's education system, its saving rate, and the quality of its government determine its output, the way they are going to approach in terms of their policies. Now all these three explanations sound intuitively correct, right? But each applies over a different time frame. In short run, say a few years, the first answer is right one. Year on year movement in the output are primarily driven by the movements in demand. Changes in demand, perhaps as a result of change in consumer confidence or other factors, can lead to decrease in output or an increase in output, that is an expansion. In the medium run, say a decade, that is 10 years, the second answer is right one. Over the medium run, the economy tends to return to the level of output which is determined by supply side factors, because from the producer standpoint, supply side factors matter, and this includes the capital stock, the level of technology, and the size of labor force. Over a decade, these factors move sufficiently slow that we can take them as given, which means we can take them to be constant as well. In the long run, say a few decades or more, the third answer is right one. To understand why China has been able to sustain high growth rates since 1980s, we must understand why both the capital stock and the level of technology in China are increasing so fast. To do so, we must look at the factors like the savings rate, the education system, and the role of the government in that particular country. This way of thinking about the determinants of output underlines macroeconomics, and it underlines the organization of the upcoming chapters which we are going to discuss. To summarize what we have discussed so far in this chapter is we started off with the three measures of aggregate output, that is GDP. Then we talked about the difference between nominal and the real GDP. After that, we defined what is unemployment rate, how to interpret unemployment rate, then what is inflation and what are its key measures, and why economists should worry about inflation or unemployment numbers. Then we talked about the GDP deflator and CPI as measures of inflation. In the next section, we talked about the Phillips curve and the OKUN'S law, which basically explain the linkages between inflation, unemployment, and the output gap. Finally, we talked about the notion of long run, medium run, and the short run, and how to go about interpreting it in the macroeconomic discourse. If you like the content of our videos and want us to contribute more in future, you can support our channel by subscribing to it and following us on social media platforms. Have a good day.